China does seem like it is,
good morning,
willing to tolerate greater volatility in the yuan.
Oh, look, I think that it's very clear what's going on here. If you look until sort of the middle of June, then actually the yuan was stronger relative to non-dollar currencies. If you look at it, it only gone down sort of half of what the DXY had appreciated. And clearly, since the middle of June, China has decided that, well, it's all gloves off, and there's been a very distinct, very marked depreciation in the yuan. So quite apart from dollar strength, we've seen about 3% yuan weakness since the middle of June, and it's pretty clear to us that this is very clearly a Chinese central bank policy.
So, Paul, is it possible the yuan could break 7, and when do you expect that to happen if you do?
Oh, yeah, look, I think what we're seeing now is very politically motivated. There are very clear signals out there to America that they really need to sort of, back off on these tariffs. At the moment, there's a trade war going on here, and America is being, very brutally beaten in this because of the fact it's allowed this depreciation in yuan, which, it suits China from a whole bunch of other perspectives. I saw what you were saying there about the current account, but obviously we've seen slowdown in China. We've seen the 2 RRR moves this year. So, the fact that all that's happening, it really suits China to be able to have depreciated its currency 3%, and there's a very clear signal there that if America doesn't back off on the tariff threats, it's going to keep going and keep going. 7's in play, 750's in play. If America, doesn't wake up, we could even be looking at something way beyond that. So, and what you have to remember, yuan doesn't move in isolation. Wow. If you go and look at, for instance, the Thai baht, here in Thailand where I am, that's been tracking the yuan very, very closely. So, America really is scoring a massive own goal in terms of what it's allowing the emerging markets to do with their currencies.
Yeah, Paul, David here in Hong Kong. I mean, a lot of what's happening now sort of reminds me of what happened back in 2015, 2016, that shock devaluation, if you will, in the currency. Why do you think we're not getting, though, the same sort of disruption and distortion in markets that took place back then? What's different this time around?
Oh, look, that's really interesting, and we're actually looking for sort of, early signals of that. I think, one thing is that we've got some disruption already taking place in markets. If you look at it, the emerging market equity story was already coming off the rails before, we got these currency interventions from the Chinese authorities in the middle of June. We already had a lot of weakness in emerging market equities before that. But what we're looking at very closely is high yield, because, if you remember back in 2015, as you rightly say, the contagion went very wide indeed. And I think one of the early warning signs, one of the canaries in the coal mine for the secondary effects of this is going to be, for instance, the US high yield market. So you've got to watch that like a hawk.
And should I be expecting a blowout then in spreads when I look at high yield? And I know it's very hard to say when that's going to happen, but just fancy a guess. Are we talking about something possible this year of that sort?
Oh, yeah, absolutely. Look, I really wouldn't want to try and guess a time either, to be honest, David. But I think the point is, it's on the cards, it's in play. So, I think what you have to do is you have to be cognizant of that. I don't think there's any remote reason for being exposed to the US high yield market right now, because this is kind of hanging over it like a sword of Damocles. We don't know when the thread's going to get cut, but unless the US backs off on tariffs, I think the Chinese government statement is pretty clear what they're going to keep doing. Today's fix, it's very clear what they're going to keep doing. That contagion pretty much has to come in at some stage. So I guess there's two questions. One is, do we think that Trump will back down on the tariff rhetoric? And maybe there's some soft signs of that today, but I have no idea of the psychology of Trump. I'm not the person to try and guess that. And if not, then yeah, you're right. It's how long can markets like high yield retain these kind of narrow spreads?